What's good, guys, and welcome back to episode 6 of Mastering the Market. This is my free comprehensive online course to teach you guys how I trade Forex and make money in the markets every single day. Now, on today's episode, I'm going to be teaching you about risk management. So, we've taught you the whole strategy now, all the entries, all of the ways that we mark up our charts, and all of that stuff. So if you did miss that, go back and watch the previous episodes because you are going to need that before watching this episode. In this episode, though, I'm going to teach you exactly how we manage risk to make sure that we are responsible traders, don't lose too much of our accounts, and if we do end up taking a loss, which is part of the game, it doesn't end up breaking our accounts or blowing everything and we've lost our money. So, as I just said, in the last episode we learned about all the entry types that we have in this strategy that I trade. Now that you've got these strategies, you need to be able to understand how to execute the trades, how to manage risk, and make sure that you're responsibly trading and not just gambling in the markets, full porting as it's called, or going all in, etc. We need to manage risk appropriately, and how are we going to do that? Well, there are numerous ways that we can approach this, but the first method, which is the method I personally use, is a percentage-based risk. So what this means is we are risking a certain percentage of our account or our portfolio for each trade. So essentially how this works is the size of the order is going to change each time that we place a trade, and this is going to change depending on the size of our stop loss. Obviously we don't have a fixed stop loss. Our stop loss is dependent on the market. It's very malleable, it keeps changing. So depending on the size of our stop loss, we are going to risk a certain amount. Now you might be saying, SG, how much should I risk for each trade? Should I risk 25%, 10%, 1%? What is it? Well, firstly, 25%, no way, right? We want to be risking, personally, I advise always risking 1% per trade. Now, it's a little bit difficult when you come with a smaller account. If you've got an account, with $100, $500, whatever it is, a bit of a smaller account, risking that 1% is going to be somewhat inconsequential for you, right? You're not going to feel as if you're actually risking anything if you're only risking $1 per trade or $5 per trade. And maybe 1% might be too small and you might not actually be able to pop an order that small on your brokerage. So because of that, I would say if you had a smaller account, something like a starter account with $100, $200, something like that, then you'd be okay risking 5% as a maximum. But with a prop firm account especially, or a larger personal account that you've got that's your main account, I would say stick to that 1% risk. So you want to be risking 1% per trade, potentially 2%. When you get later into the game where you've got, a lot of funding and all that stuff, a lot of people do just attempt to full margin these phase 1 accounts, but I definitely don't advise that. And we want to be trading, we don't want to just be pure prop firm traders that only can trade props because they full margin the first phases and they fail loads of them and all that stuff. We want to trade like proper traders. So we want to be able to do what we do on live accounts and on prop accounts. And because of that, we want to risk responsibly and continue to be good traders. So how does this work then? Well, if we're risking 1% per trade, we're going to say for this example that we have a $100,000 account. So let's say that it's a funded account with 100k in it. Okay, now what does this mean? Well, let's say that we start to get into a trade. Obviously this is a pure example and this is not a position, but let's say that we get into a trade like this and we determine that our stop loss is going to be around here at 67 pips. Just a random number, obviously, but let's say that we have 67 pips. Now you might be thinking this is very difficult to work out. What lot size should I use? What order size should I use? Now you're going to hear the word lot size a lot. Now lot size essentially is the size of your order. In futures they use contract size as their order sort of scale, but in Forex we're going to be using lots. So a 1 lot order is 1 lot, obviously. 2 lot, 3 lot, 4 lot, that is a bigger order. So when you have more lots, you're increasing the order size, and essentially that is how many units of the certain currency you are trading. So if you check on your brokerage, it'll tell you how many units per lot, and then obviously however many lots is timesing that by a certain amount. Now the way that we are going to calculate this risk is we are going to go onto Google and we're going to type in Forex lot size calculator. Now once you start to get more used to this and you start to do it every single day, I have got to the point where I can now just calculate in my head how many lots I would need to be risking 1%. But when I started off, I was using a lot size calculator too, so that is what we are going to do here. Now the one that I like the most is this one here. This is cashbackforex.com. It's their lot size calculator. Now this is very simple because all it's going to show you is the instrument that you're trading. So for example here, obviously we're trading gold, the deposit currency, so what currency your account is. If you're a funded account, it's most likely going to be in dollars. Now this one, you can either choose to do the stop loss price in, the actual price, and then it's going to calculate the pips for you. Or if you know the pips, just like we did here, then you click to switch the stop loss in pips. And then what we would do is put that here. 67 pips was our stop loss. Our account balance was 100,000. We're looking to risk 1%. Leave this one as normal. XAU USD 1 pip size is 0.1, so that's fine. Now what we want to do is click this little thing here. Now a lot of people ask me, why is it not calculating the lot size? You have to click this button here, contract size. Now this is going to be on your MT5, so later on when we get into how MT5 and all that stuff works, we'll delve into this, but for now we can just leave it as this, because the contract size that most brokerages use in Forex for gold is 100 units per lot. So then we just click calculate, and now we know that we need a 1.493 lot size for this trade. Now that means that when we do go and place the order, whether it's a sell stop or a buy stop or whatever it is, even if it was a market execution, we need to enter into the terminal 1.49, or we could round that up clearly to 1.5 lots when we enter this trade, and that is going to risk exactly $1,000 for us. So that is very, very easy. Once you do execute the trade, you're going to know that you're risking only 1% of the trade. And what that means, especially as well with funded accounts, is you have a maximum drawdown of 10%. Now this means that we could get 9 trades wrong in a row and we still wouldn't blow the account. So because of that, we're going to give ourselves a much better chance of keeping that account alive, which at the end of the day is your number one goal as a trader. Your capital preservation is your number one goal. Your goal as a trader isn't to make money, it's to keep your capital alive and stay safe in the market. So because of that, we need to make sure that we manage risk, and we are doing exactly that here. Now, if you do have any questions, please comment down below. Any questions that you do have. Comment also your average pip stop loss size. I want to know what's... So yeah, comment down any questions that you have about this down below, and I will answer them for you. If you tell me also what your average stop loss size is, then I can do the calculation for you and help you out on that one in the meantime. But the next method that I want to talk to you about is fixed lots. Now a lot of people that I know and a lot of my close friends who are traders trade with fixed lots, and it's going to be a little bit easier for you when getting into the trade. There's a little bit less calculation going on, so if you do prefer that, then that is definitely something that you can do. But essentially how this is going to work for you is, what you're going to do is you're going to calculate your average stop loss over a certain period. Now if you are a newer trader, this probably isn't going to be ideal for you, so I would say when you're getting into a couple of months down the line and you've taken a few trades, started to journal all your trades, which we'll get into later. Once you started to journal your trades, then you can begin to understand what your average stop loss is. For example, my average stop loss is somewhere around 50 pips. So because of that, what we are going to do is we would calculate for the size of the account what a 50 pip stop loss would be for risking 1%. So we go back over here, 50 pip stop loss. Let's say again that we're using a 100k account. 50 pip stop loss is going to be a 2 lot. We can already work that on our head, but that is a 2 lot. So essentially what that means is no matter what trade I'm taking, I could be popping a 2 lot. Now this might mean in some cases that you're under risking, but in the other cases you'll be over risking. But as we said, over a couple of months, that is going to average out if you do have an average stop loss of 50 pips. And what that means, like I said, is every time when you get into the trade, you don't have to go into the calculator and figure it out. You can just put the same lots in and take that trade as normal. Personally, I don't do this. I like to risk a certain percent each trade, just because I feel a lot safer that way, and I think it's a better way to approach the market. So I would recommend using that fixed percentage, but those are definitely the 2 ways you can go about managing risk. Now, the next thing I want to talk to you about, this is a key risk management tool that we do use in the market. So I want to show you about this. Let's say that we end up breaking into this level up here. I want to put this on the chart real quick. So let's say that we end up getting some closures above this level here on the chart, and we want to take a trade. What can we do? Well, let's say that we get into longs at this position here. What we're going to do here is our stop loss is going to be below here, but we're going to set a break-even point before we even get into the trade. So what does that mean? Well, a break-even point is essentially the place where when price taps that level, you're going to put your stop loss to break even. And what that means is you'll put your stop loss to the entry price, so that now there's no more risk on the table. If price comes back down to your entry, then you're going to get stopped out at a break-even price, so no loss, no win. And this is a risk management tool that we use a lot to save our capital and, you know, keep us in the trade. If we think there's a possibility that price continues upwards, but we don't want to close out yet, and we also don't want to leave ourselves with risk on the table. We'll bring our stop loss up to break even, and we'll let the trade run out from there. Now, the way that I find these points is, let's say we've got in longs here again, like this. I would be looking at minor rejection areas throughout this range. So as I discussed in the previous episode, when we do close back within the range, we are likely to fill that range up. So this trade should come up here to TP at the top of this range here, but there are some minor rejection levels over here. So because of that, there is a possibility that price can reject at those levels again, and we'd be back in a loss or stuck in drawdown for a while, and we don't want that, right? So what we're going to do is we're going to come and put our level. I normally use these blue lines. We're going to look at these rejection points over here. We've got one here, and we've got a couple, you know, up here like this. Now these areas here are probably going to be the areas where I would put my stop loss to break even. So the first one would be the break even point. I don't know how many pips this is going to be for us. Yeah, it's going to be 15, 16 pips, so that's okay. So once we reach that level up here, I would probably end up putting my stop loss to break even like this. Also, I often recommend closing partials at that point. So what you can do is, I'll teach you how to do this in the next episodes, but I will teach you how to close partials of the trade. So what that means is you can close 50% of the trade or 75% of the trade to secure some profit, so that if it does come back down to break even down here, you don't end up with nothing and you do keep some of your profits. But then what I do is I would allow this trade to keep running and continue to take partials at all of these rejection levels until we hit TP. Now this essentially, like I just said, secures profit, gives us a win essentially, and secures the profit for the day. We don't want to, you know, get in a huge profit and let that trade run down and hit us out break even. So we'll take some of that profit off the table, and we'll be happy with that. We won't look back once we've done it. Once you make that decision to do it, then you have done it for a reason. But like I said, at these rejection areas, we can set our break-even point. You can also do it at a place where price is tapped every time where it's come up. So for example, every time when we've come above this range, we have tapped to at least this level up here as well. So because of that, we can use an area like that, and that could be our break-even point. So what I'll normally do is I'll have this set before I get into the trade. I'll put my stop loss to break even sign over here. And once price comes up and taps that level, I'll put my stops to break even, close 50% of the trade, and the rest can either run to TP or it's going to hit us out break even. Like I said, guys, that's another way that we manage risk. We take that risk off the table and secure some profits, and that is a key thing about being a trader. Never ever be afraid to take some profits. Any profit is good profit. But yeah, guys, that is going to be it for today. So those are the risk management tools that I do use to be a safe trader in the market. You know, we don't want to just be gambling like most traders, and we don't want to be risking too much. You might think, you know, maybe if I risk 10%, I'm going to make way more profit. But then also when that loss hits you, it's going to hit you a lot harder. It can lead to revenge trading, trying to make back your losses, all that stuff. It is not good. So trust me, be safe from the start, manage risk appropriately, and you'll be good to go as a trader. But if you do have any questions, please leave them in the comment below. If you did like this video, please press like and leave a subscribe if you are new. There's so much free value coming out here. It is absolutely crazy. And like I said, if you have any questions, also drop them in the Discord. So I'll put the Discord link down below. We have a crazy community in there. Super helpful, super valuable. So jump in there, ask me any questions. I will reply to everyone in there, obviously. Other than that, guys, I do appreciate you all very much. Thank you very much for watching, and goodbye. Peace out.